Assalamualaikum. My name is Siti Khadijah Widya Muhammad Fauzi, and today I will be presenting on the topic of Bai al-Murabaha as part of Islamic finance assignment. This presentation explores how Murabaha works, its issues, and possible solutions for the betterment of Islamic financial practices. Bai al-Murabaha is an Islamic financial contract where the bank purchases a specific item and then sells it to the customer at a markup price. This markup is agreed in advance and disclosed clearly. Unlike conventional loans, this transaction avoids riba or interest, making it compliant with Islamic law. It's essentially a sale, not a loan, and that is what makes it permissible in Islam. Key features of Murabaha. Murabaha must involve a tangible asset such as property, vehicles, or equipment. There is no interest charge, and the profit is earned from selling the asset, not from lending the money. And secondly, the sale is fully transparent with both the original cost and profit margin revealed to the customer. And lastly, the price is fixed upfront so there are no unexpected increases. How is Murabaha works? First, the customer requests the bank to buy a specific item. The bank then purchases the item from the seller. After that, the bank resells the item to the customer with a disclosed profit. The customer then pays the total price in either a lump sum or through installment. I will give you a real-life example. For example, let's say a client wants to buy a car worth 20,000 ringgit. The bank buys the car for 20,000 ringgit and then sells it to the client for 22,000 ringgit. This includes a 2,000 ringgit profit. The client can then pay this 22,000 ringgit in monthly installment over 4 years. This way, the bank earns profit legally without charging interest. One of the major controversies surrounding the use of Murabaha in Islamic finance is its questionable application in certain cases, particularly involving commodity Murabaha or Tawarruk. In this transaction, the bank and the customer are technically buying and selling commodities such as oil or metal, but only on paper. The client never sees or takes possession of the goods. The real purpose of the transaction is simply to generate cash, not to purchase or use an actual asset. This practice raises concerns among many Sharia scholars. They argue that when these transactions are used to create the illusion of trade without any real asset exchange, it starts to resemble a conventional loan with interest, which is riba and strictly prohibited in Islam. Critics say this defeats the purpose of Islamic finance, which is meant to be different from conventional finance. Instead of promoting real trade, transparency, and ethical profit, it appears as if Islamic banks are mimicking conventional practices by changing the terminology but keeping the same function. This has led to growing concerns about whether such practices truly comply with the spirit of Sharia or are just legal loopholes. To address this issue, scholars and institutions have proposed several solutions. Firstly, there is a call to align all commodity Murabaha structures with international Sharia standards, such as those set by the Accounting and Auditing Organization for Islamic Financial Institutions. These standards emphasize avoiding organized tawarruk, where no real asset involvement occurs. Secondly, Islamic financial institutions must strengthen governance and operational producer to ensure transparency, actual asset transfer, and full Sharia compliance. This includes strict monitoring and proper documentation of every step in the transaction. Lastly, scholars such as Abu Satta Abu Guddah suggest that commodity Murabaha should only be used for 15 to 20% of deposit activities to avoid over-reliance on this controversial method. This goal is to bring Islamic finance back to its roots with real trade, ethical profit, and share risk. Another major issue is the growing preference of Islamic banks for commodity Murabaha deposit instead of investment accounts. This shift became especially apparent after the implementation of the Islamic Financial Services Act in 2013. Under the IFSA, investment accounts are subject to stricter regulations. They require more documentation, more governance, and involve higher risk for both banks and customers. Because of these burdens, many banks prefer to offer commodity murabaha structures, which are simpler and safer. However, this goes against the primary goal of Islamic finance, which is to promote profit and loss sharing, justice, and fair investment. Investment accounts are meant to embody these values by engaging in real business activity where risk and reward are shared. By avoiding these accounts, Islamic banks are drifting away from the values they were built upon. They are choosing safer, low-risk structures that resemble conventional fixed deposits instead of offering truly Islamic alternatives. To resolve this, 3 key steps are recommended. First, there need to be increased customer awareness. Many people do not understand the purpose or importance of Islamic investment accounts. Through campaigns, training sessions, and seminars, banks can educate the public about their Sharia value and benefit. Second, Islamic banks must build internal expertise. They need strong risk management system and better understanding of investment account structures. This would help them manage risk while still complying with Sharia principles. Third, there should be policy improvement. Regulators and financial institutions should work together to make investment accounts more viable and attractive. This includes offering better returns, simplifying procedures, and incentivizing ethical investment models. With these changes, banks can support true Islamic finance rather than defaulting the convenience. The third and perhaps most concerning issue is the lack of real economic impact from many murabah transactions, especially those involving in commodities. In many cases, these transactions are not tied to real economic activities. They exist only on paper and are used to move money between parties in a way that technically avoid interest, but doesn't contribute to the economy. There is no actual trade, no goods exchange, and no services rendered. This means that while Islamic banks may appear to be active, they are not contributing meaningfully to job creation, entrepreneurship, or business development. They are creating financial products that benefit the bank and few clients, but do not benefit society as a whole. This contradicts the maqasid al-Sharia, or objective of Islamic law, which aim to protect wealth, promote justice, and ensure fairness in economic dealings. When Islamic finance starts looking like conventional finance, but without the real economic value, it fails to make it higher purpose. To tackle this problem, scholars propose a shift in focus from paper-based transaction to real sector financing. Islamic banks should finance industries like agriculture, manufacturing, trade and services sector that contribute directly to the economy. This creates jobs, build communities, and strengthen the national economy. Next, banks are encouraged to provide equity-based contracts such as mudarabah and musyarakah. These models involve shared risk and shared profit. They reflect the spirit of Islamic finance more accurately than fixed profit structure. Finally, there must be a mindset reform. Islamic banks and their stakeholders must move away from profit maximization as the main goal. Instead, they should adopt a value-based approach that emphasizes ethical behavior, fairness, and long-term sustainability. This is what will preserve the integrity and future of Islamic finance. In conclusion, while murabaha is a powerful tool in Islamic finance, its overuse and misuse could harm its legitimacy. To preserve the ethical foundation of Islamic finance, we must focus on genuine trade, risk sharing, and real economic value. Islamic banking should reflect not just the law, but the true spirit of Sharia, which is fairness, justice, and social benefit.